Hello and welcome to Week in Markets. Today I'm joined by Lexi Herriott, who's going to help us walk through the major events this week and how the markets has responded to those. So Lexi, I suppose the US, the government continues to be in shutdown, so there's no key economic data releases this week. So it's really been more about the UK, and that's really kind of grabbed investors' attention. So in terms of the events that have happened, what's really caught your eye?
Yeah, in the UK this week we've had jobs data and wage growth data.
Yep.
So this was a bit disappointing. Yep. The ONS labour force survey for the UK showed an unexpected rise in unemployment to 4.8% in the 3 months to August, and this was the highest since May 2021 and was driven mainly by the younger population.
And I suppose the unemployment rate has been on a steady increase, perhaps over the last 18 months, nearly 2 years. So we're at 4.8%. We were actually below 4% about 18 months ago. So it is this trend of softness coming through the UK labour market.
Yeah, and you've also seen slowing in jobs creation,
Yep.
Which was driven really by part-time jobs and mainly in the over 65s. But the response rate to these surveys has been declining, making them a little less reliable. So when you look at HMRC payrolls, which is more reliable, this is showing signs of stabilisation in the number of payrolled employees. So this rose by 10,000 between July and August, and it is expected to fall again in September. But the real concern has been the effect of last year's budget on UK employment levels. But revisions to payrolls show that the number of payrolled employees has only fallen by 90,000. And although this is still quite high, it's significantly lower than the 126,000 fall that was expected previously.
I think it's worth mentioning that we heard from Andrew Bailey, who's the governor of the Bank of England, this week, and he had highlighted that the data appears to be slowing for the UK labour market, and the economy is running under capacity. So I think that's important, and we'll come on to the reasons why. But in terms of wage growth data, what happened there?
Private sector wage growth eased to 4.4%, so this is the slowest since the end of 2021, which should give the Bank of England signs that inflation can ease further. In the public sector, wages remained elevated at 4.7%, but this continued weakening of the labour market and slowdown in wage growth might give the Bank of England some confidence in cutting interest rates over the next few months, but they are expected to remain quite cautious until there's clear evidence of a reduction in wage pressure.
And wages have been, certainly for the last 2 years, have been elevated well above where you'd expect the Bank of England to be more comfortable that inflation's closer to 2%. Wages have been above 5%. And that's due to tight labour markets, but also we've seen increases in the minimum wages. So it's a positive that we're seeing some normalisation in wage growth, and as you say, should give the Bank of England more confidence to lower interest rates. Markets expecting quite a modest reduction in interest rates over the next 12 months, about 0.5%. I suppose if we see more evidence of this, then markets will certainly price in more interest rate cuts. Okay, I suppose some key economic data there. How have investors and markets responded to it?
Yeah, so the bond market reaction was really positive, with gilts rallying, and this was also supported by further information on the UK budget that's upcoming in the next few months.
Yeah, so I suppose bonds are rallying because they're less concerned about inflation and growth is slowing. So bonds typically perform better in that environment, and that has certainly been the case. But as you say, we've had Rachel Reeves, the Chancellor, talk about the up-and-coming budget, giving some hints that there'll be some pullback within government spending, but also prospect of, unfortunately, looking to increase taxes once again. Reports overnight, perhaps this coming through on energy via VAT increases. But what this means for bonds is that the government's being more fiscally conservative, and that's what bond investors like. So you're right to point out that's really helped bond yields rally as well. And in addition to this, we've had oil prices lower again, so they're down about 10% so far this month, down to about Brent oil's down to about $60 a barrel. If you think at the start of the year we're at about $75 a barrel. So yeah, you're right. UK bond markets rallying, but so have global bond markets.
Yeah, the driver of global markets, though, has really been last Friday, US and China trade tensions escalated quite significantly as Trump threatened 100% tariffs on China. So this resulted in equity drawdowns, but both bonds and golds acted as a diversifier and rallied on Friday. Following the weekend, the tensions eased, and over the week, equities have recovered. Equity prices have recovered, but bonds have not given back those positive returns, and they've continued to act as a diversifier for our multi-asset portfolios.
That's a great point. Bonds are back as a diversifier, which is great for multi-asset, as you say. And let's just finishing off thinking about the week ahead. Right now, we're seeing a number of companies report on their third quarter earnings, which on the whole have been slightly better than expected. US large cap financials and as well in Europe on the consumer side. Looking ahead, any companies that you're keeping an eye on? Yeah,
so over the next week, UK banks, MasterCard, McDonald's are expected to report, as well as Tesla, which will be the first mega cap to report on earnings this season.
That's great. Thank you, Lexi. And thank you all for watching. I hope you have a great weekend, and we'll see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.